Hi everyone, my name is Maxim and I'm the CEO of MarketsView. Welcome to another video on the financial terminology. Looking at the name of this video, you may be thinking, okay, beta. Is he going to talk to us about Greek alphabet? No, I'm not going to talk to you about Greek alphabet. Just don't think about that. Market beta is a measure of market risk. So it's a measure of volatility. Volatility is obviously corresponding to risk. The higher the volatility, the riskier the investment. So beta is a measure of volatility of a particular stock, of a portfolio, of an index potentially. So let's talk a bit about what it is. How do we actually define beta? Beta is a measure of non-diversifiable risk of an asset portfolio, yeah? Or either one or another. How does that work? So initial risk that any asset has, we're going to talk about assets, but that also relates to portfolios. Suppose an asset, a stock A, yeah? So a stock A has some amount of risk, which can be measured by its volatility, which is usually measured by standard deviation. Those of you doing some kinds of statistics may know what that is. It's a measure of the kind of spread of data from its mean. So the mean return and how the other returns are spread from it. Okay, so when we have that risk measured by standard deviation, that volatility, some of it can be diversified away. So if you diversify your portfolio into different asset classes, different assets, just maybe different countries, different markets, international markets, that should decrease the risk of your portfolio. However, there is some risk which doesn't depend on diversification and you just can't take it away. That risk will always exist. That is non-diversifiable risk, and that is what beta measures. Let's look at numbers. A beta of 1, it means that the stock is as volatile as the market. So it has exactly the same volatility as the market. It's not riskier, it's not less riskier, it's just as the market. If beta of a stock is less than 1, that means that the stock is less volatile than the market. It means it's less risky. If beta is above 1, that means that the stock is more volatile than the market, so it's riskier. You can see a beta measure in some of our reports saying that the beta of that company is this. Now you know what that means and how to interpret that. One last thing I want to mention is that obviously measure of volatility is important. However, even if volatility is low, that doesn't mean that a high jump or drop in price cannot happen. So please be aware of that on the market. Even if beta is low, that doesn't mean that the stock is volatile, that the stock is not volatile at all. Please be aware of that. I will finish with a funny fact here. Absolutely no stocks in the S&P 500 index are less volatile than the index itself. So if you were to invest in something safe and you choose the equities market, which is risky in the first place, you would be better just following and replicating the S&P 500 than stock picking out of there in terms of risk, because the beta of all individual stocks in the S&P 500 is higher than for the index overall. Thanks a lot for watching and stay tuned for the following videos.